Good afternoon, and thank you for joining us for today's panel on what projects are currently deemed attractive. We'll be considering a number of factors, and helping us to go through these today we have Andrew Ferrier, John Forwood, Tim Elliott and Simon Klimt with me today on the panel. So let's get straight into it. Firstly, maybe John, let's consider what makes a project stand out. You know, what is a particularly attractive investment? And if you can, maybe provide some examples of recent mining projects you've either invested in or funded that you deemed attractive.
Sure, thanks, Sophie. Look, you know, there's many attributes that you can look at to make something attractive, but a couple that are standouts for us are scale, and the other one is grade, and preferably, you know, having both of those together is ideal. You know, a couple of the projects that we at Lowell have invested in more recently that have one or both of those attributes. One that's been in the news just recently is Cardinal Resources in Ghana in West Africa. That's a very big scale project. It's a pre-development project, but 5 million ounces, you know, that's world class or world scale by anyone in anyone's language. And the reason why we invested in that was because of that scale. You know, it had goldfields on the register. Then it had a Russian company called Nord Gold come in for the scale, and now it's subject to a all cash takeover bid by a Chinese group. So it certainly ticked the scale box. In terms of grade, one that we've invested in recently is Musgrave Minerals. They're intersected some bonanza high grade hits in a very well endowed region of infrastructure near Kew in Western Australia. So yeah, they're just two of the attributes that we look at.
Okay, great. Tim, what about yourself? What are some of the standouts in terms of what makes a particularly attractive investment for Regal?
Yeah, sure. Thanks, Sophie. And look, I think John's covered it pretty well, but I suppose I think primarily about risk, about return, and about asset quality, first and foremost. It's obviously easier when we're talking about large scale, long life, low cost operations. But look, at Regal, we have probably a higher risk appetite, provided we're compensated for taking on greater risk. So we'll flex on those parameters where it makes commercial sense to do so. Obviously, grade is very important, or equivalently coal quality in the case of coal. We're commodity agnostic. We just really want good assets in any commodity. I'd also just encourage project proponents to focus on de-risking projects as much as they focus on adding value. That certainly becomes relevant when you're looking to write a big check. Look, I mean, Regal's cornerstone, probably the building of most of the mines built by junior miners in the last sort of period of time. Pilbara's Pilgangoora lithium mine's been a great example of that. Also, West African Resources has a very high grade gold mine in Africa that's gone exceptionally well. At the moment, we're big supporters of things like Red 5, which has got a tremendous gold project over in Western Australia, which again has scale and looks very undervalued compared to peers. And then similarly, De Grey has been a tremendous success story from an exploration perspective that's come along in leaps and bounds over the last 6 months. That looks like it's sitting on a truly world-class gold deposit again in our backyard in WA.
Okay, maybe let's look at financial metrics now and stress testing. I guess that's very much governed by what commodity prices and exchange rates are assumed. There's a lot of uncertainty out there at the moment. Andrew, how can investors get comfortable with price assumptions that are directly implied by supply and demand factors in the current environment?
Yeah, thanks, Sophie. And obviously, commodity prices and currency assumptions are vitally important in any mining project, and they're two obvious inputs that we run a lot of stress tests and sensitivities over. I think the few key points I want to stress here is just understanding the correlation between commodity prices and currencies and making sure you're aware of that when you're looking at the different ranges of prices in your models. And then also an area where we see a lot of misunderstanding is just when you're looking at your domestic cost base, for an example, an Australian gold mine, how much of that is actually Australian dollar denominated, and how much is that actually got to flow through US dollar price? For example, oil and cyanide and these other things. So just understanding how much of your cost base is actually denominated in domestic currency is very important. These are fairly obvious in Australia and Canada, but can be more complex in South America, but there's a lot higher proportion of US dollar cost base. We run stress tests. We also are running a lot of scenario testing at the moment, just sort of thinking outside the box and what could happen. And when these commodity prices do move, and you have to put your mine in care and maintenance for 6 months, what does that do to your balance sheet? So that's essentially where we sit. In terms of understanding what commodity price to use, I think, and looking at downside stress testing, you just got to come back to the cost curve, especially for base metals, understanding that, commodity prices can go only so low for so long, sort of sub 90th percentile on the cost curve. So if you're comfortable within that range, you should be okay.
Yeah, absolutely. And Simon, what's the biggest swing in the assumptions today that we need to consider for the commodities and currencies?
Yeah, look, it is a difficult time to be thinking about long-term price forecasts. So we tend, to, like the others, to look at costs as the first level, as really honing more on the cost side than on the revenue side. And as Andrew said, if we can find projects that are low end of the cost curve, then we assume that if prices do go down, that we will be somewhat protected. Our projects will be somewhat protected from that. So we do like to spend a lot more time focusing on the cost side, because as we all know, trying to actually forecast prices is a very difficult exercise, and one that none of us will ever get right.
Yeah, no, that's for sure. Well, that's a good segue into the next question in terms of cost pressures, whether they're capital cost pressures or operating cost pressures. As we've both heard, it's an important factor. How do you get comfort, John, in terms of how do you get that comfort up front that the assumptions are reasonable, that indeed you are looking at a project that is on the lowest end of the cost curve? And I guess, how do you risk adjust for these as well?
Yeah, look, just as a sort of a screening tool, I think you can pretty quickly benchmark, the costs against, your database or experience of other projects, particularly in, well-known operating commodities, if you like. For, gold, for example, there's a number of sort of rule of thumb metrics that you can use. But I think sort of stepping back from that, particularly in terms of capital costs, you need to have a view as to where you are in the cost cycle. People talk about the price cycle, but I think you need to have a view as to, are we under a lot of pressure in terms of costs? Certainly the last boom during the 2000s, there were a huge number of capital cost blowouts that occurred, because of the cost pressures, because the upfront estimation wasn't being done by, particularly well. And accounting for those cost escalations. So I think that's a very important overriding factor to take into account when you're looking at costs.
And Andrew, what about yourself? How do you get comfort up front that the assumptions are reasonable? And then also, what are your acceptable tolerances to these factors? Are we sort of putting plus or minus 10%, plus or minus 20%? Can you give some insight there?
Yeah, no problems. And I think John hit the nail on the head. Essentially, you've got to understand where you are in that inflationary cycle. And I guess we've learned most from the experience is it's not just inflationary pressures that have caused CapEx blowouts for us. They've much more likely come from engineering scope changes. What you build is not what needs to be built. So when we look at CapEx cost pressures, we're far more focused on who's done the engineering, have you gone for the right steps, have you used world-class engineers, and we're much more focused on that, because from a risk perspective, that's where things can blow out, tremendously, as we have seen. In terms of, I guess, error bars or risk tolerances on CapEx, we are we're a little bit lopsided in terms of it's not plus or minus 10 or 15%. It's probably -5 plus 30%, even for a feasibility study level, if you really want to sort of understand the extremes of what could happen. Because I've never really seen a project come in at -30%, but I have seen it come in at plus 30%. So it's not really a normal distribution of outcomes on that front.
Okay. Let's talk COVID-19, obviously governing our lifestyles today. But do you think that the impact of COVID-19 will weigh heavily on investment decisions going forward, Simon? And I guess, let's talk about the negatives and the positives that's coming out of COVID-19, if we can.
Well, it's obviously had an impact both on the supply side and on the demand side. But I guess we've got to we're involved in long-term projects, and so we certainly see this as a short-term issue because for 15, 20-year projects, COVID-19 won't be a factor in the long run. And also for development projects, we're some way until production. So as long as they've got protocols in place and that construction and/or production can go ahead, which it seems to have done extremely well, certainly in Australia, we sort of see it as a short-term issue. Don't know if Tim has a similar view or different view.
No, look, I completely agree. These are long life assets we're talking about, so I don't see meaningful impact going forward. Maybe we'll see greater awareness of supply chain dependency. But no, otherwise I agree with Simon. I think, assuming that we have the vaccine at some point in the next year or so, then I think this is short term and doesn't play a lot into my thinking about new projects.
Okay, that's great. And I guess we've covered a lot of factors that deem a project attractive. John, what other factors haven't we covered that are critical in deeming a project attractive? I guess, you've got funding risk, JV partnership risk, production upside potential, political risk, we've got nationalism. There's a number of different things that I guess we also have to consider when we're looking at projects. John, what do you think? What are some other factors that you think are critical?
Yeah, look, I mean, we play mainly in the micro or even nano end of the spectrum, and probably one of the big overriding risks in that small part of the sector is funding risk. A company can have a wonderful looking project on paper, but if it just doesn't have the balance sheet or even, or the market cap, that the market will believe that the equity component of that project finance can be obtained, then it's that company will find itself often in a vicious cycle of the market doesn't believe the project's going to happen, so the share price goes down, so the likelihood of raising the equity becomes less and less. Everything else being equal, I think lower capex projects are definitely preferred, particularly in that part of the sector, to high capex projects. Not to say it's impossible, but if you've got a $10 million market cap company trying to fund $1 billion project, it's very hard to see that happening. So that's definitely front of mind for us as one of the risks that we are constantly looking at.
Tim, interested to hear what you think.
Yeah, so I think I just echo some of what Andrew said earlier about capex risk. That's certainly something we think a fair bit about. Pleasingly, we're seeing fewer projects running over budget compared to the DFS. We're no longer in that hyperinflation environment that we were in a decade ago. But we do tend to see a reasonable amount of creep in capex from a scoping study working through to a DFS, which we consider. Partnerships, I think, are generally a good thing where you can bring other investors into the project often at the asset level, but I'd strongly suggest they shouldn't be done until construction stage. In terms of jurisdictions, look, obviously Australia and Canada and a few other places are first class, but look, we're open-minded about jurisdiction. There's only a small number where we probably wouldn't invest, but where sovereign risk is higher, we expect to be compensated for taking that greater degree of risk. So look, I think finally I just say that project proponents do need to appreciate that capital is a lot more expensive when you're pre-construction and unfunded. But equally, there's tremendous opportunities for wealth creation in the Australian mining sector, and I'd encourage investors to get involved and back good projects. But equally, this is a technical area. It's important to do the work.
Okay, let's finally talk about ESG. It's a big umbrella. A lot's in it. It seems hard to pin down what it means sometimes, and obviously it means something different for everyone. But what are the company or project attributes that you look for when making an investment decision? And I guess, is ESG more important or less important than absolute and relative value? Andrew, maybe we can get your thoughts on that, please.
Yeah, thanks. It's certainly hard to pin down exactly in a short period of time, but I think at Pacific Royal, we view ESG, we're a fund manager, we view ESG as a responsibility essentially, and that doing ESG the right way is simply good for business. So when we complete due diligence, obviously ESG is through our whole investment cycle, but just focusing on an initial investment, was very focused on the underlying project, what's the social license of the company, all technical related issues and how they relate to ESG. But I think more importantly in that is understanding what the management and the board's attitude towards ESG as well, because at the end of the day, they're going to be driving the ESG performance throughout the whole business. So understanding their views is critically important. And we obviously have these discussions up front before we make any investments. And as you said, ESG can mean a lot of things. We obviously have our own internal policies and protocols in terms of transparency reporting. We're also a member of the UNPRI. So it's something that's obviously particularly important to us and obviously is growing important to everyone around us. In terms of how we view ESG, a lot of people sort of refer to it as risk mitigation, which is absolutely true. But that's probably only half of it. We also see it as huge value enhancement as well. If you do this stuff right, your cost of capital is going to come down. New doors are going to open to you in terms of partners. You're going to become more attractive as an investment proposition and a takeover target. So it's two edges to it all. And we see it as just adding value more than mitigating risk.
And then Simon, just quickly from yourself in the interest of time, what ESG means to yourself?
Well, I think like Andrew, it actually is accretive in some respects to returns, I guess, in terms of your original question, because quite frankly, if you do it well and the projects you're involved in do it well, then that is actually accretive because, again, you're not going to have issues with social license. You're not going to have issues with problems with environmental disruption or disturbances that weren't planned, and so that's accretive to the individual project. And then as a raiser of capital ourselves, if our policies are good and are explainable on the ESG front, we will attract more capital as well. So I think it's actually integrated into the whole investing process.